Let's welcome our market master for the day, Rakesh Arora, Head of Research India at Macquarie Capital Securities. Good morning, Rakesh. You join us at a very auspicious and opportune moment. A fresh all-time high has been set by the Nifty. Are you raising your Nifty target for 2015?
Okay, so basically, our new target is 9,960, which is 17% upside from current levels. And this is driven by a 15-time earnings estimate for FY17. Largely, this is in line with 17-year average P multiples that we're seeing for the market. We don't think there's going to be too much of PED rating from here on, because current multiples are consistent with around 6.5–7% GDP growth, which is what we are forecasting for next year. So clearly it is going to be earnings driven from here on. And PE should remain at around 15 times for next year.
Hi Rakesh, is there any upside risk to your Nifty targets if crude falls further?
At the moment it is difficult to say, but yes, earnings for FY16 and 17 are conservatively forecasted by consensus to grow at 19–20%. And there's a huge amount of operating and financial leverage into it. For every 100 basis point drop in inflation, which will happen if crude continues to fall, there's a 30 basis point improvement in EBITDA margins for the top 200 companies. And this could mean around 1 percentage point into earnings growth. So yes, if crude starts to fall more aggressively, and there could be upside. But at the moment, looking at the current conditions and how the economy is picking up, we are comfortable with this kind of 19–20% earnings growth for the market at the moment.
Okay, Rakesh, well, you've given us some really aggressive targets. What are the themes that one can now play? Which are the stocks that will be the leaders of this rally to the almost 10,000 mark?
Okay, so largely, we are playing 2–3 key themes out there. So we are looking at revival in infrastructure spending. We are looking at interest rate cuts to start to happen. And we are also looking at, inflation dropping off. So in this context, 2–3 sectors really stand out in a big way. The first one is industrials, where we have the highest overweight, then banks, and the third is autos. So basically playing, the theme of infrastructure, interest rate cut and inflation through these sectors. And we are underweight on staples, energy, materials, utilities to compensate for this overweight. And, I believe that among the stocks, we are pushing Axis Bank, ICICI Bank, L&T, Maruti and TCS. These are our top 5 ideas. Among the mid caps, we have Crompton Greaves, TVS Motors, Strides Arcolab, and these are our top 3 mid cap ideas basically.
Okay, I'll come to your top buys in a bit, Rakesh, but yesterday we saw a big spurt in metal stocks like JSPL, and we have seen coal prices fall significantly as well. Do you get a sense that there could be a big impact because of this on names like JSPL, or is it just short covering that we saw yesterday?
See, companies like JSPL are trading at extremely low valuations, and these have been one of the most favorite stocks which punters have been shorting in the market. So any kind of little bit of buying can lead to large short coverings, which is what we are seeing in the stock at the moment. I don't think they benefit immediately from lower coal prices globally, because these guys are largely dependent on coal availability in India, which hasn't really improved much despite Coal India's good efforts. So I would say that it's more of a short covering that we are seeing at the moment. And it's also a reminder to a lot of investors that these stocks are at extremely cheap valuations. And one should refrain from shorting at these levels. There's a chance of getting caught in this short trade.
Okay. Well, the auto stocks have already been very big wealth creators in the last 6 months. We have seen big moves in auto ancillaries, MRF, as well Eicher Motor and the likes. You like TVS Motors from that bunch even now. You're calling it your better mid-cap pick. Anything else in the auto space, auto ancillary space?
See, there's no doubt that most of these stocks have run up quite a bit, but I think growth can actually surprise on the higher side. I mean, even if we take a company as large as Maruti, I don't think anybody is building more than 15% volume growth. But if there's a revival, these companies can easily do 20-25% and volume growth, and that would have a huge impact on their earnings. So I would be tempted to really add on to all these auto names on all declines. Remember that with interest rate cuts which we're expecting and oil prices falling, already the cost of ownership and operating a vehicle is actually coming down quite dramatically. So and last few years have been pretty bad, so there would be a lot of pent-up demand in the system. So I won't be surprised with higher than average growth rate in volumes, and that might make these stocks look attractive on high volume numbers.
Okay. In your report, you also say that you have now gone sharply overweight on industrials. Can you just elaborate on the stocks that you like now? Will it be just restricted to large caps, or will you look into the mid cap space as well?
Yeah, so we are largely bullish on cap good companies. So L&T, Crompton, Thermax, IRB, these are some of the names where we are bullish on, and would really recommend staying away from companies like Jayaprakash, GVK, JMR, and even BHEL, because we don't really see too much of things happening on at least the power generation side. So it is more of a selective call, but we are overweight on the subsectors where we think things will pick up. So 3 subsectors where we are really bullish on infrastructure is roads, railways, and power transmission. So that is where we are picking up stocks.
All right. Well, just to shift away from stocks for a bit, Rakesh, what is the downside risk to this market and the downside risk to your Nifty target?
See, first of all, we think that, given the global situation, investors will be willing to give a slightly longer rope to India. And the hope trade which is currently happening or underway in India will continue for some more time. So we don't think that, market is likely to see a big correction anytime soon. Number 2 is that government is in any case doing a lot of stuff. Some might be slower than what people expected, but they are moving in the right direction. So there would be a little bit of news flows coming through every now and then. And then next quarter, there's a chance that RBI bites the bullet and cuts interest rate. So there are too many positives which can support the market. So we are not really expecting a big correction. Number 2 is that if correction was to happen for some event, I think it will be limited to 4-5%, and that should be a buying opportunity for investors to get in for longer term. So to answer your question, I don't think there's any kind of panic right now in the markets.
Rakesh, one theme that has done extremely well are the companies that benefit from lower crude prices, paints, tires, and of course, oil marketing companies. You still like them?
Yeah, I mean, you see, OMC still have some steam to go. So we like HPCL, though it has run up quite a bit, but we think HPCL can continue to perform, going forward. Obviously, all these companies that you mentioned in the paint sector, and even FMCG companies, etc., are going to benefit from fall in oil prices and general slowdown in commodities. But there would be a kind of a lag effect, and final product prices are going to catch up. So this is more like a trade for the next 3 to 6 months. I don't think it will be a structural rally which we'll see in these kind of stocks. So even OMCs, I would say that it's more of a trade, for 3 to 6 months time only.
All right, that's a bunch of trading ideas and a brave new target, 9,960. Rakesh Arora, thank you very much for joining us with all those details.